Guide to Bookkeeping. Bookkeeping is a fundamental aspect of financial management that ensures the proper recording, classification, and organization of financial transactions. It forms the backbone of accounting, as it provides the data that will eventually be analyzed to assess a business's performance and financial health. Let's dive deeper into the components of bookkeeping, the types of systems, and why it's crucial for any business. 1. Key concepts in bookkeeping. Transactions. Every financial event in a business is considered a transaction. This could range from receiving money from customers, income, to paying vendors, expenses. Transactions are recorded as they occur to maintain an accurate and up-to-date financial picture. Accounts. Accounts help categorize transactions so that they can be summarized and analyzed effectively. The 5 main categories of accounts are: O. Assets. These are resources owned by the business that provide future economic benefits. They can be tangible, like equipment, cash, or inventory, or intangible, like patents or goodwill. Examples include cash, accounts receivable, money owed to the business, and property. O. Liabilities. These are obligations or debts the business owes to outsiders. Common liabilities include accounts payable, money the business owes to suppliers, loans, and mortgages. Essentially, liabilities represent future sacrifices of economic benefits. O. Equity, also referred to as owner's equity or net worth. Equity represents the residual interest in the assets of the business after deducting liabilities. In a simple equation, equity equals assets, liabilities. For example, when a business earns a profit, it increases the owner's equity. O. Revenue. Revenue, or income, refers to the money the business earns from its operations. This can include sales of products, services, interest from investments, or any other form of income. Revenue increases equity because it represents value flowing into the business. O. Expenses. These are costs incurred by the business in the process of generating revenue. Examples include salaries, rent, utilities, and materials. Expenses reduce equity since they represent money flowing out of the business to keep operations running. 2. Debits and credits. One of the most fundamental aspects of bookkeeping is understanding debits and credits, which are used in the double-entry bookkeeping system. Every transaction impacts at least 2 accounts, and the total debits must always equal the total credits for the accounting equation to stay balanced. Debit, Dr. A debit increases the balance of asset and expense accounts but decreases the balance of liability, equity, and revenue accounts. Credit, Cr. A credit increases the balance of liability, equity, and revenue accounts but decreases the balance of asset and expense accounts. For example, when a business receives cash from a customer, it would record the following entry. Debit, cash increases asset. Credit, sales revenue, increases revenue. In this system, every financial transaction affects at least 2 accounts, and the sum of debits must always equal the sum of credits, keeping the accounts balanced. 3. The double-entry system. The double-entry system is the foundation of modern accounting. The main principle of this system is that every financial transaction affects 2 or more accounts in such a way that the accounting equation, assets equals liabilities plus equity, always remains balanced. Example transaction in the double-entry system. A business buys $2,000 worth of office furniture on credit. O. Debit, office furniture, asset, $2,000, increases assets. O. Credit, accounts payable, liability, $2,000, increases liabilities. This system is more reliable than single-entry bookkeeping, which only records one side of each transaction, because it provides a more complete picture of the financial situation. Benefits of double-entry system. Error detection ensures that the accounts are balanced, making it easier to spot errors or discrepancies. Financial insight helps track all assets, liabilities, equity, revenue, and expenses in detail. Compliance, it's often required for businesses to comply with accounting standards and laws. 4. The accounting cycle. The accounting cycle is the process of recording and processing all financial transactions within an accounting period, usually monthly, quarterly, or annually. It involves several steps. 1. Identify transactions. This involves gathering source documents like invoices, receipts, and bank statements. These documents serve as proof of each financial transaction. 2. Record transactions in journals. After identifying transactions, they are recorded in the journal, also called the Book of Original Entry. This journal lists all transactions chronologically. Each transaction is recorded with a corresponding debit and credit. 3. Post to the ledger. After recording transactions in the journal, the entries are posted to the general ledger. The general ledger categorizes the transactions into specific accounts, e.g., cash, sales, rent expense, and summarizes the account balances. 4. Prepare a trial balance. At the end of the accounting period, a trial balance is prepared to ensure that the total debits equal the total credits. This serves as a check for any posting errors. 5. Make adjusting entries. Some transactions may not have been captured fully or accurately by the end of the period, e.g., depreciation, prepaid expenses. These adjustments ensure that revenues and expenses are recorded in the appropriate periods, accrual accounting. 6. Prepare financial statements. Using the adjusted balances, the main financial statements are prepared. O income statement, P&L shows profits by subtracting expenses from revenues. O balance sheet summarizes assets, liabilities, and equity at a specific date. O cash flow statement shows the business's cash inflows and outflows. 7. Close the books. After the financial statements are prepared, revenue and expense accounts are closed to reset them for the next accounting period. The net income, or loss, is transferred to equity. 5. Types of bookkeeping systems. Single-entry bookkeeping. This is a simpler system primarily used by small businesses or individuals. In single entry, each transaction is recorded only once, either as income or expense, and there's no need to balance debits and credits. This method is less detailed and doesn't provide as complete a financial picture, making it harder to detect errors or prepare formal financial statements. Example of single entry: if a business receives $1,000 from a client, it simply records income, $1,000. There is no need to track the debit or credit sides of the transaction. Double-entry bookkeeping. As mentioned earlier, this system is more complex but provides a comprehensive record of financial transactions. Every transaction is recorded in at least two accounts, one as a debit and the other as a credit, ensuring that the accounting equation is always balanced. Most businesses use this system because it provides accurate, detailed records. 6. Importance of bookkeeping. Legal compliance. Many countries require businesses to keep accurate financial records for tax and regulatory purposes. Bookkeeping ensures compliance with legal obligations like tax filings and audits. Accurate financial reporting. Proper bookkeeping ensures the accuracy of financial statements, which are critical for understanding a business's financial health. Investors, creditors, and management rely on these reports to make informed decisions. Tax preparation. Bookkeeping keeps track of income and expenses, helping businesses to accurately file their taxes and take advantage of deductions or credits. Financial analysis and decision-making. Bookkeeping allows for real-time monitoring of business performance. Owners can track trends, understand profitability, and make strategic decisions based on accurate financial data. Cash flow management. By keeping track of incoming and outgoing cash, bookkeeping helps businesses maintain liquidity and avoid cash shortfalls. Investor confidence. Accurate bookkeeping can attract investors by providing them with confidence in the business's financial management. 7. Bookkeeping methods and tools. Manual bookkeeping. Traditionally, bookkeeping was done manually using pen and paper. While this method is rare today, some small businesses may still use it for simplicity. Spreadsheet-based bookkeeping. Many small businesses use spreadsheets, like Excel, to record transactions. Spreadsheets can be customized and offer a flexible solution, but they require a good understanding of bookkeeping principles. Accounting software. Most modern businesses use accounting software like QuickBooks, Xero, or FreshBooks. These tools automate much of the bookkeeping process, reducing the chance of human error, and often include additional features like invoicing, payroll, and financial reporting.